Okay, perfect. So let's get started. My name is Kumar Sharram, and today I'll be presenting to your group our latest investment offering, which is a 97 units apartment complex. It's an already existing apartment complex in Denton, Texas. So initially, to start off with, this is a 506C offering, which means that it is only for accredited investors only. For people who don't know what accredited investors is, on a high level, there are of course multiple ways on which somebody qualifies for the accredited investor, but on a high level, it is the main basic ways is that if you have net worth of $1 million, and it's a global net worth, it doesn't have to be just US assets. Global net worth minus your personal residence, if it is more than $1 million, then you are considered accredited investors. That's one way. And the second way is if it's husband and wife together working, if you guys make $300,000 per year for the past 2 years and expect the same to be making in the current year, then you qualify for being an accredited investor. So in any 506 offering, there is a proof of accredited, being accredited is required before doing an investment. So with that said, let's move on. So today we'll be covering a lot of things about this investment offering, which I'll deep dive into each sections. So with the first disclaimer is whatever we will be projecting and showing in this presentation is based on our best analysis and based on our experience. We are forecasting the results and everything. But again, anything related to it is you have to wait for yourself, do your due diligence, talk to anybody that you know who has done this kind of investments, and get any professional advice if need be for any of your tax situation and everything before you make any decision in order to invest in this offering. So I'll start with the introductions about me and who is this guy who's presenting it today. Uh, I'm like probably most of you guys. I come with an IT background. So I came to this country into the, hey, Rajiv,
Hey Kumar, so sorry I'm late.
no problem, as usual.
Yeah,
Not
I
too
know.
bad. Just kidding. But anyway, we just got started. We're just doing the introductions and a basic uh, explanation of things. Yeah.
Got it.
Uh,
Thank you.
so the introduction, yeah. So I'm just like most of you guys. I have an IT background. Uh, just became a full-time real estate professional like 3 years ago. But I started my real estate journey started off in early in 2010. So I've been in real estate for almost like 10 years now, 10 plus years. So the initial couple of years I didn't do much, but my real estate actual journey started from around 2014 onwards. So we started getting in doing the corporate tenanted properties, which you see on the slides. Like we got into two corporate tenanted properties, which we sold recently. And Rajiv is actually one of the investor in Dollar General Property, so he can share you some of his experience as well. And then we got into foreclosure properties. So we bought a lot of foreclosure properties in New Jersey, and we bought around like 70 plus properties altogether. And I currently have hold like 50 plus properties of that as rentals, and I individually own them. And the map shows you the geographical locations of these properties. So we are scattered around both Central and South Jersey, and that's my bread and butter. So that's when, after building that portfolio, I was able to quit my IT job in 2018, August 15th. I used that date to quit my 9 to 5 retirement. And since then, I've been a full-time real estate investor. So after 2018, 2019, we started off with multifamily properties. And that's when we did this Atlanta property. It's a portfolio of 250 units, which we recently again sold in June for a very good IRR for the investors. So then 2020 was a wash year. We didn't do much. So 2021, we kicked off again with an acquisition of 172 units in Longview, Texas, and 119 units in Lubbock, Texas, and 125 units in Irving, Texas. So that's our experience has been in the multifamily. So we currently have an experience of around 666 units, and there are almost another 700 units in the pipeline that we are working on, and this 97 units is one of them. So the other partners that I have in this deal is a company named VFR Capital Investment, headed by Wesley Yates. This is my third deal with this group. My last three properties that I was talking about, mentioning about, I have collaborated with them, VFR Capital Investments. Uh, Basically, we try to work with local partners because they are the boots on the ground. And while my company, Pro Investors Capital, is based out of New Jersey, so I always make a point, and my strategy is to always work with local partners who bring in that local expertise, and they are the boots on the ground. They are the eyes for the property to execute the business plan that we have. And we also have another company called Yari Equity Partners, who are also helping us with some of the requirements, bringing the strength to the table in terms of doing some capital raising for us. So the other affiliates that are involved in this deal are Capstone is going to be our property management company. They're also helping us with the due diligence. They also helped us with the due diligence of the property. So when I say due diligence, usually we get a 2 days period by the seller to go through each and every unit of the property. So we already did that all analysis. I was part of that 2 days. I was there 2 days. I walked through the lot of the units myself physically. So I have a pretty good idea about this property because we get access to walk through every unit of the property. So what is the story about this particular investment property? So this is a 97 unit property. It's a C class property in a B class neighborhood. When I say C class and B class, on a high level, the definition is anything like 60s and 70s built based on the age, you call them as like C class. If it is more newer, if it is like between 80s to 2000 to early 2000, they're like B class. If it is anything 2005 and above, probably it's considered as A class. That's how, based on the age, the properties are classified into different classes. So this is 70s built, so it's a C class property. And there are also classes for the neighborhoods. The worst of it is where like war zones are considered D class. C class are considered more working class, Hispanic neighborhoods, things like that, like working class, construction workers, this kind of neighborhoods. B class is little step up to that, and A class is completely like white collar, professional jobs and things like that. So it's this is more on in a B class neighborhood, but based on the age, it is a C class. We always like this kind of combination because B class helps us get our increased rent, which is our business proposition here. Because we are coming in, we are trying to buy a property and increase the value of the property. And B class, being a B class neighborhood, why is a B class? Because the average income in this census tract is around like 70 to $75,000 as median income. So which is a good demographics to kind of take that increase in rent bumps. And the value here in this property is, if you guys remember in Texas back in February of this year, there was a winter freeze. Because of that winter freeze, some of the uh, apartments had a breakdown of their plumbing, and that caused some of the units had the plumbing issues. So they had to shut down them and fix up that plumbing of those units. So that's how there were around 21 units that have been taken offline because of the winter freeze that we have back in February. But you could ask, like, so what happens? Like, in this case, the seller is taking the insurance proceeds, and that's his profit. and he doesn't want to do the work, and he's selling it to somebody like us. So for us, it's a value add because we are taking this property with at 66% occupancy. There's 21 plus there's few more. Together, these units is what we are taking them offline. So like 33 of the units, I think, yeah, 30 of the units. So 30 of these units is currently vacant, which we are getting. So our business plan is to take this property and then rehab those units and then increase the valuation of the property, and which you will know in further slides on how this value is being increased and everything. But that's on a high level. So in terms of the location, for people who are not familiar with Denton, Denton is part of DFW, Dallas Fort Worth metropolitan area. It comes into the north part of the DFW metro. For people who are familiar with Dallas, north of Dallas is the northeast is predominantly is what Desis live and everything. It's one of the most happening area, which has Frisco, McKinney, and all these places. This is not really far from those locations. This is comes towards the northwest part of the DFW metro, and this is on the path to progress. There's still a lot of land and a lot of things available, and Denton is right now in the path to progress, and that's the reason we first of all like to invest in Texas, because I don't have to tell much about Texas, where everybody knows that it's the most happening state right now with a lot of investments. They're already number one in the job growth, the rent growth, and all of that metrics. They're ranking pretty good, and that's the reason we've been investing very heavily in Texas, and especially Dallas, and that to North Dallas is where all the action is happening, and Denton being in the north part of things, and it is a recipient of a lot of that action, and it also home to one of the two. It's a college town. It has University of North Texas. That's a pretty good. Uh, there's a lot of education as well. So it's also one of the education hubs in the DFW Metroplex. And I won't go into details of a lot of things which you can, of course, review, and you guys have access to all of this content. Uh, so the executive summary, we are buying this property for 9.75 million, which puts it at 100,000 a unit. So each unit is coming to around like 100,000. We are projecting a 1.85 equity multiple. I'll explain in due course what that means. And we have two investment options here, a Class A share and a Class B share, which again, I will dive deep into further slides, where the minimum investment is 25,000 for a Class A and 50,000 for Class B. The whole period is we are underwriting as 5 years, but this is just an underwriting purpose. Doesn't mean that we will wait for 5 years. If the business process works, maybe in 2 years from now, we will exit in 2 years from now. So, but the underwriting is written for 5 years. And the LP GP split is 60-40, which means the profit sharing goes 60% to the limited partners and 40% to the general partners. When for some people who don't know what general partner means, it will be my company, VFR Capital, and Yeti Equity Partners. We are all considered as general partners because we are doing the whole 9 yards. We got the deal, we're setting up the team, we will execute the business plan, and ultimately exit to generate the profits. That's the whole responsibilities for general partnership. And also, let me also clarify that general partner also takes the loan responsibility. So we as general partners, we sign on the loan. Limited partners do not sign on the loan, so they don't have any liability with respect to the loans. So anything very related to the loan, it's on our thing. So it's on our tab. So just to let you know. So we have a lot of skin in the game apart from investing the 10%, which is usually mandated by the senior lender, which I'll go into again details. So we are projecting a 9% cash on cash return and a 16% IRR. And there are also cost segregation, which means the tax saving benefits, which I'll also detail. There is a separate slide where I'll go deeper into what are the tax benefits that we have. In terms of the property, it is a 1974 built. Right now, it is 66% occupancy. The average square footage of the apartments is 671. There are total 97 of these. Current rent, they have it around like $1.27 per square foot. And it's a 13 two-story buildings, and it's in a 4.6 acre parcel. So again, I'll not go into details of everything, because these things are generic about what Texas is. But at high level, I'll mention that this is where it is. Denton is located. It's in the north section of DFW, and it is strategically located on highways and everything. You can just Google and you will see the address of why I'm talking about a strategic location in terms of highways and everything. And one of the key thing that I want to point out is between 2000 and 2010, it grew by 40%. And most of you know how Texas is growing in terms of the population. So I don't want to brag more about that. And you can again research more about it. So North Texas is considered of all these counties and everything, and it's pretty much growing, and the population estimates and everything. And again, I wouldn't go deep dive into it. You can just read all this content about the growth of Denton and how it is driving. And I'll just point out here, it is this Manchester House is located here. It's very strategically located in terms of accessing the rest of the metro. It's right off the highway, Interstate 35 East, and it's very close to all the employment centers, and University of North Texas is right located here. So many people again like that's a pretty good big university. And I know personally many friends who attended University of North Texas, and many people know about Denton. And Denton is also on top of Flowermont. Flowermont is again a premium area. That's also a lot of bases, high net worth bases live in Flowermont. So this is just next on top of Flowermont.
Hey, Kumar,
Yes.
can I have a couple questions
Sure.
answered just quickly?
Sure.
So geographically, I know where Flower Mound is. How many miles north is Denton from there? I know I can look it up, but do you know on
Yeah,
the top
just
of
look
your
it
head?
up. Honestly, I
You
top
don't
of my
know?
head, I
Okay,
don't know, but it is the town adjacent to Flowermont.
got it. And this slide that you're going through, I know you sent a couple links. Is this slide that you shared, or this is a little different from what you shared on the links?
What I have, the portal, the links take you to the portal. The
Okay,
portal has the same slides. Only thing that, as I explained the day or the Friday, since Friday, we had a change in terms of the loan because we finalized the loan. So only change will be there. But I'm gonna just update this on the portal as well.
okay,
So it will
okay.
be the updated whenever
Same thing.
anybody
Got it. Okay,
will be accessing the link, it will be at the updated version. I
got it.
haven't updated it in the portal, but as soon as I'm done with the session, I'm going to update it.
Okay, sounds
Okay.
good. Thank you.
So again, employment and everything, I won't dive into it because you can read this content. Because I would want to spend more time on the Q&A rather than talking about Denton and all the stuff. Okay. So this is a high level about what are the rents, current rents. This is from CoStar. CoStar is a company that collects all the data related to the commercial real estate. And so this is from the CoStar report. Right now, the studios are going around like 758, the one bedrooms around 935, and two bedroom around 1059. And for people who are familiar with Dallas growth and everything, you know how the rents are also growing. You can Google and see like how much is the rent growth in the Dallas and everything. It's phenomenal. It's double digit. So that's the reason we feel confident in invest in Texas, because for our business model to work, the rents have to increase. And there is no better place right now for this rent increase than investing in Texas. So, and especially Dallas, that's the reason we feel very comfortable about investing in these areas. And this is the breakdown of how the 97 units are. So there are some studios, one bedrooms, and there is a healthy ratio. What we like here is there is a healthy ratio, 30% of which is one bedrooms and remaining is two bedrooms. That's a pretty good healthy ratio to have. So this again from CrowStar, it projects about what is the forecasted the rents are going to be in the Dallas market and the sub market of Denton, everything. Again, I wouldn't want to brag again about it. Most of people are aware of the growth that Dallas especially is happening. So what's our plan? So as I mentioned, the 21 units are were down because of that ice freeze that they have. The plumbing has been fixed. There is no mold and everything. Everything is to the studs. In the next slides, you will see some of the pictures of how those units look. So, and I personally, I come from a rehab background. As I told you, I bought around like 70 plus properties in New Jersey in foreclosures. And for me, buying a crappy property and turning them around, I had the tons of those experience because I personally dealt with it. And that's the reason I feel very confident about what is involved here. But let me tell you, like, since we walked through those 21 units, actually we were told that 21 units are down to the studs, but in fact, only like 6 of them are down to the studs. The remaining of that 12 of the 20 remainder of whatever that 15 or 14 is, uh, they are technically down, but it's just very minimal, just the sheetrock damage and everything. But the appliances are already there, the backsplash, the cabinets, everything are already there in those things. And there is also one discovery that we made when we walked through is uh, they had a container parked in the thing, and we found that they have quartz cabinets and multiple sinks and things like that, which is going to come part as the offering, uh, and that's enough to at least do like 15 of units to do the make them premium units. So the game plan is that there are currently 33 units that are vacant, so 21 of them were because of the winter freeze, and some are generally vacant. So we are coming in and initially taking all of those units which are easy ones. We're going to immediately work on that the very first month and then put them onto the market for leasing. And then the last will be those 6 units which are really down to the studs, which will take another couple of months. So the game plan is to come and then execute this entire renovations in around like 3 months technically. But in our underwriting, we gave ourselves as 6 months but we hope to get it done in 3 months, but we still conservative underwrote it for like 6 months. So we'll be doing the countertops, replacing appliances to black, putting vinyl plank flooring, paint, lights, fixtures, and everything. It's a typical rehab that typically goes on in any classic, if it's a classic apartment unit. These are the typical things that are going on throughout the country. Everybody it does the same thing. This is a typical value add that people do. And apart from that, we also plan to invest a little bit money on the exteriors, doing some little bit of parking lot and just spicing up things, and also investing a little bit on the amenities. There's a basketball court and everything. We want to just spice it up a little bit, add a dog park, and upgrade a little bit of the playground. And there's some area which you'll see in the pictures where we were thinking of adding a pickleball court. And all these are factored into the $1.1 million capex budget that we allocated to do everything. But we are definitely having some savings because of some of the product that we already have and some of the units which we originally projected to be as down, but they are not. So we might have some shaving, but again, we still want to underwrite it as $1.5 million just because if there is any contingencies or anything goes as a surprises, we still have that cushion to absorb those hiccups.
Kumar, did you say 1.1 or 1.5?
$1.1 million is the capex
Okay,
budget.
got it. Got
And
it.
you will see
Thanks.
the big breakdown also in the further slides. By investing that $1.1 million, we estimate to increase the gross income by around $270,000. And the commercial properties are valued based on the income that it is generated. So an increase of $270,000 of gross income is going to translate into increase in the valuation of the property, which is again, further slides, you will see what we are factoring and everything. So that's the outcome we are expecting from the capex budget that we are implementing in this location. And all the pictures that you see are what the current condition of the property. And these are the premium units. They have nice cabinets and everything. And as I said, I personally have walked through. And again, I plan to also host in my YouTube channel some of these videos. I haven't done that yet, but I will post some of the videos that I personally took during my walkthroughs, and I'll post it on my channel. And that links will be also on the portal for you to also check it out. So this is the breakdown of the capex for the interior units. We are planning to allocate $100,000 here, and some for exterior. And together, all you can again look into the details because you have access to this. So together, we are forecasting a $1.1 million of capex budget. If we could save, we will save, but we are still having a 1.1 million. I'm sorry if I said 1.5. It's $1.1 million capex budget. So these are some of the current condition pictures. These are
Kumar, if you don't mind, can you go back to the last slide? I think
Sure.
I had a lot of stuff on it.
Mhm.
Yeah, that looks like a busy screen. No, this is good. You have laid out quite a bit extent study on this, and
Right.
costs are all factored in. So it's good for us to kind of see this.
Absolutely.
So thanks for sharing it.
No problem. And again, you have access to this, so you can at leisure just look at all the information, and anything you can always feel free to reach out if there's anything that you have questions on the numbers or anything.
Sounds good. Thanks.
Kumar, just a follow-up question. The total buying price is 9.75, right?
Right.
Now,
And then
is
on
that
top of that, we will be investing $1.1 million.
got
And
it?
again,
Okay, that
further
answers.
slides will have all those analysis. We'll have the financial underwriting and everything as well presented.
Got it. Got it. That was my question. That is it like
Yeah,
cash
it will be
positive? Where is
covered.
1.1
No,
million
it will
coming
be
from?
covered
Got it.
there is a slide where you will see the nuts and bolts of the entire numbers, because
Got
I
it.
know that we are all IT guys predominantly. We are numbers guys. When we see numbers, that's logic to us. So I totally understand that, and that will be answered. Yeah,
Perfect. Thank you, man.
right. So these are the go ahead.
Yeah, just one more question on that back slide. You kind of mentioned you're doing a lot of kind of upgrades. I see all the interior stuff, but some of the stuff that you mentioned the prior slide, like the dog park, the playground, basketball court, pickleball court, there's no dollars against any of those items. So I may just kind of clarify kind of what you mentioned
Right.
in the previous slides, and then there's no dollars associated in your budget.
Right. So what we did was we are trying to allocate some of the you see here, we said 21 units, $25,000.
Mm-hmm.
But I told you it's only 6 units that requires a complete thing. So we're going to allocate some of the money that we initially allocated to do those kind of fancy things like dog park and all the play bar, which are nice to have. They're not mandatory, but they're nice to have.
Got it. Okay. Yeah, because that definitely helps on the curb appeal.
Right.
So from the timeline perspective, Kumar, I think you shared between 1 to 3 months, given that you
it won't
also
be
have
1 to 3 months. The first month will be to work on the easy ones. Where
Right.
I said, right, the 6 ones are the ones down to the studs, which I'll show you in the next slide. Yeah.
So 21 units.
This is the down to the studs pictures.
Got
So
it.
these ones will be the ones which will take more time. So the goal will be whatever are like easy ones that can be knocked off pretty quickly. So those will be addressed. So it could be like maybe like 10 or 15, depending on the schedule. We will initially work on those, and those will be put on the market. And once those are working on, these heavy lifts will be done at the end. So that way, the easiest ones, which we could, because we will get rent, right, on them, which we do. So the easiest ones, which takes less amount of effort, will be the first ones to be worked on the very first month. And then eventually they'll be going on to the tough ones, which is the ones which requires the most amount of work.
Thanks, Kumar, for
Which
clarifying
luckily,
that.
which luckily is only like 6 of them.
Yeah, no, that makes sense. I think you have a good plan.
Right.
So I mean, the idea is to start getting rent as soon as possible to make these fixed as much.
But if you see, but when the further I will show you that we still underwrote that we won't get red for like 6 months and everything, just to be conservative. See, we rather
Yeah.
be conservative and project still a decent number, so that way anything better is always good. Everybody loves
True.
we beating the expectations, right?
True.
Rather than
So
setting high
this,
expectations, we always set up very basic expectations, and we always strive to beat that.
yeah, that's fine, Kumar. So underwriting says 6 months. This is for the 21 units only, or there are other things also factored into the 6 months? I know
The,
you have a big
the 6 months
plan.
will be for the entire capex budget. We should be able to comfortably, because there's no really major stuff. Honestly speaking, it's one of the easiest projects, because I know like the previous project that we did, which is in Irving, 125 units, that's a 0% occupied unit. That's like a heavy lift.
Got
That's,
it.
we are still saying that our good case is 6 months, but we underwrote as 1 year. But that's 0%. We are saying 6 months, and this is, we're talking about like just 6 units being the tough ones, and the rest being pretty normal stuff. So
Yeah.
we're pretty confident about this.
So for the 6 units that you're saying that are down
Mhm.
to studs, and let's say 21 units that you invest or upgrade them to, these are, I mean, we are looking at 1.1 million to kind of upgrade these with the kind of little bit on the outside, a little bit on the increase in
Right.
total look and feel around
Mhm.
this.
Right.
So are we saying that we're going to spend all this, or are we saying that we will spend as we need to, but it may not happen?
We will spend wherever it gives the bang for the buck. For example, let's say the interior, of course, wherever have to be invested to make them marketable to get the premium rents. There's no compromise on that. That has to be done. So those 33 units, whatever are down right now, they're straight away going to the premium package, which we are trying to, which will get us the top dollar. So there will be no compromise on that. So, and anything related to safety is also going to be not a compromise, because anything that we could improve, it is a trip hazard or things like that, or an electrical thing or anything like that of that sort. Those are the, so the priority will be always given to first get the maximization of rents, which means going into higher occupancy levels, and then the first of all safety, and then the occupancy, and then comes the nice to haves. So it could probably, we could invest some, and we could again sometimes prioritize too. Let's say we might get a surprise, for example. So we might have to allocate some budget from the nice to haves and put it back to here. So ultimately, the goal of that 1.1 million is, I think we calculated saying that if we invest $1.5 million, we will get our optimized we will get a property where it will be at the best marketable asset as possible. But of course, in the due course of time, if something contingencies come or something like that, we might have to just reshuffle the dollars here and there.
Got
But
it.
the thought process will be to kind of spend anything on anything to kind of bring it to the optimum condition.
Got it. And I know you touched base on this early on briefly, that you had 2 days and you did some inspections and other stuff, walkthroughs and stuff.
It's not me
Um,
doing it. There's professionals does it. We pay them fee for it per unit. It's a deadum. We're just doing it in addition to them. Since they're anyhow walking through the units as a professionals, we are just accompanying them to just get an idea of the entire apartment complex.
Got it. Thanks for sharing that. So with this walkthrough and with this analysis that they did, the inspection report or whatever they give you back, were there any other concerns regarding safety, electrical, or any other things that have been reported? I
Yes,
know plumbing, you
that is
said it's
the
fixed already.
entire capex is based on the due diligence that was done by the professionals. So the
Okay,
capex is always adjust. Yeah,
it's been
the
accommodated,
way, yeah,
adjusted
the
for it.
way it
Okay,
works is usually when you put an offer, you go with a high level capex plan. But when you go and do the walkthrough, you kind of refine it, and that's how it finally ended up with that 1.1 million, which means that everything and that has been suggested in terms of safety and everything has been accounted for.
Got it. Thank you, Kumar. You can move on.
Yeah. So these are the pictures, and these are some of the exterior pictures. Uh, the seller has invested quite a bit of money, and I'll tell you what the seller paid for it. The seller bought it for at 65 a door back in 4 or 5 years, I believe. And I think he invested definitely some amount of money, at least a million or two, million and a half. I'm pretty sure he might have invested till date, because this fencing and everything, this gives a nice pop, and he already put in all of that sum. This is usually what we do. If we would have bought a property without all this is usually what we do. Cedar planks are now the in thing, so anytime you put a cedar plank fence, that gives a nice pop. The seller already did that. He painted the entire exterior, and it did definitely invest some money on it. And all we are trying to do is now take it to the next level. So he already bought it to one level. We want to take it to the next level. So these are some of the pictures. So these are, again, you can go through the layouts and everything what we have in the offering. And this is a breakdown of the units in terms of the square footage and the unit mix. So now comes to the share options. As I mentioned, we are giving investors two options, because what we feel that not every investor is alike, because some people are less risk aversive, some people are more risk takers. So that's the reason whenever we try to do any offerings, we try to kind of give them a mix of both. That is how the Class A shares and Class B shares have came up. Class A shares are more for people who are risk aversive, or for some people who are just starting off and just wanted to test and see how this kind of investments work. So for a Class A offering, we are seeking a 25,000 as a minimum investment, and we are giving a fixed cash on cash return for that on that investment. They don't have any upside apart from the 12% that they get. And just FYI, that 12% is a tax deferred return, which means that you're not paying any taxes on the 12% on the hold period. Again, I'll go into detail in the slide when I'm talking about the tax benefits, but just I want you to just be aware of that. So for Class B members, we are seeking a $50,000 as minimum investments, and we are projecting a 9% cash on cash, 16% IRR, and 85% upside on their initial capital invested, and 8% preferred return during the whole period. When I say preferred, let's say the year one, we are only able to give like 5% to Class B investors. There's still 3%, which is still owed to you, which will be caught up eventually. Let's say in the second year also, let's say we still do only 5%. Then we have to catch up 3% from the first year, another 3% for the second year, and we have to catch up whenever there is enough money to give you. So that 8% means that you are going to get 8% no matter what. Only after the 8% is satisfied, the Class B, then only the profit sharing will be happening. So the way it works is, after the expenses and everything, after we pay off the mortgage, whatever we have for the available for distributions, first comes the Class A, they get the 12% return, and then comes Class B. If we have enough money, we give 8%. If not, we will give whatever is available. But 8% is still owed. Even after 8% is given, if there's still money left, that is when it is shared as a 60-40, where 60% again goes to Class B and 40% goes to general partners, which based on this equation, you will know that general partners wouldn't make any dime until the very end, because most of the time, which you'll see in the numbers when I show it to you.
Hey, Kumar.
Yeah.
Can I ask a question just on the previous slide?
Sure.
So hypothetically, let's say I'll take the same example. First year, 5%, second year, 5%. Three is
let's do this question to wait for the slide, which has a really good breakdown. That will probably make it very easy for you to understand. This is just a snapshot of the share structure, so you don't have to really that will be very easy for you to understand.
Okay. Sounds good.
Yeah. So the Class A investment is a 25,000. This is a little deep dive. So if somebody invests 25,000 in Class A share, they get a fixed return, which is 3%, 12%, which is $3,000 year 1, year 2, year 3, year 4, year 5. So they make a $15,000, 12% cash on cash return. Pretty simple, straightforward.
Is it on when does the person get it? 1% a month or at the year end?
1% every month. It is a monthly
1%.
distribution.
Got it.
And it's tax deferred, by the way. So it's still a
Got it.
good return. So now comes the Class B. So this is where I think if you focus, I think probably your question will be answered. If somebody invests $100,000, we took $100,000 so that it makes it easy. So based on our underwriting, if somebody invests $100,000, so the first year, based on our underwriting, we project to give 2.93% in the year 1. And in the year 2, it will be 6.25%. However, based on our plan, we're going to do the value add and do a refinance. By doing a refinance, we are projecting to give 27% of the capital back to Class B investor. It's not diluting your share, but it's just you're getting your capital back, which means you have, instead of $100,000, you will only have $70,000 put in to that account, into the capital account, right? So in the year 3, you now have only $70,000 invested into the deal, not the $100,000, because you got your 30,000 back. Based on that 70,000 investment, your projected cash on cash is 13.31%, 13.69%, and 12.74%. And based on the exit that we're projecting, we think that we will be able to give around 47% of the return will be like around $47,000 would be from the exit, from the appreciation. So cumulatively, you are making around $84,000. So that's why it's 85%. That's 1.85. So for every 100,000, it's 85,000 is the upside. But remember, you're also getting this $30,000. So it's in fact almost like you're doubling your money in almost like 5 years. It comes to a 16.61 IRR and a 9.78% cash on cash. And the average comes because it's initially it's low for the first 2 years, but later on it's 13, 13, and 12. So on an average, it comes down to 9.78. So Rajiv, you can ask your question if this slide is answering that.
Got it. So in the third year, then pretty much let's take this example. First year, we got 2.93. Second year, we got 6.28. Both are below 8 preferred.
Right.
There is a third year. Right. So third year, we got 13.31. So first we'll catch up from the balance of 8 minus 2.93. Right. Then we catch up on 8 minus 6.25. Then we catch up 8% for that year. Right. And then if there is anything left, then there will be a 60-40 in a GP.
Which again, the next slide gives you even the P&L breakdown. You'll see. Okay. This is just to give the snapshot of the returns part.
Right. But my assumption is correct, right?
Right. It will be caught up. Yes. That's exactly.
So first we catch up on the preferred and then the GP, LP.
Right. Absolutely. That's right.
Waterfall.
Third year. Then on the third year, if we hit the 13% and we were short, if year 1 and 2 are hit the projections. So what is that? We're short 5%. We're short about 2%. So that's 7%. We're short.
If you see the underwriting, that you will see the numbers. Okay. So it will be easy.
Yeah. No, and that's totally fine. But on the third year, does that just mean that number wouldn't be 13% because you're doing the catch up? Would that go down to the 8%?
That's all accounted for. All the percentage accounts for your true return. It doesn't dilute or anything like that. We will look into the numbers, when we look into the slide,
Okay. And before we go to the next slide, just one more question. I know the rate is like 4.6 or something like that, approximately, that you're financing now. So when you refinance in year 2, at the end of year 2, if the rate goes from 4.6 to 5.6 or 6.6, then there would not be a refinance. Is that correct?
If that's the case, we'll probably sell it, that property at that time, because if the interest rate were increased that much by Fed, it means that we are in a blockbuster economy where this probably asset would fly for like $20 million probably. If the interest rate go up that much, means the economy is rock solid, which means we don't have to even do refinance.
Got
Because
it.
you
Okay.
know, right, when will Fed do increase the interest rates? When the economy is like probably like super hot, which means that indirectly means the rents are up and things like that. So which means that probably we will be very much outperforming our projections if that were to happen, if the interest rates were to go up that much high.
Got it. But let's say it only goes up marginal then. So it goes from 4.6 to
No, it will,
4.7.
if it is the current environment's purchase, which we project it to be for the end of the entire year two, the current rates for a stabilized product hover around like 3 to 3.5%. And based on, we underwrote it for like refinance at 3.5%. Because a stable product, this is an unstable product right now, because it's only 66% occupied. You have to remember, that's why the interest rate is high. If not, we would get it for like 3.1, 3.2, something like that.
Okay. And what's the definition of a stable product? Is it 80%,
90 plus
90%?
percent occupancy, 90 plus percent occupancy.
90. Okay. Thank you.
Right. So here we are getting 80 LTV.
I
80
have one
LTV.
question.
Sure.
Sorry, before you move on, if you go to the previous slide. Yeah. The previous slide. Yeah, so here, like when we say that first year is like 2.93, right? And the third year is 13.31, but then I think 13.31 is on 70K, right?
Yes, right.
Whereas
why it
the
goes up.
2.93 is on 100K.
Yes.
So it's kind of, we are not saying that it's directly balances it out. It's more often 13% is on 70K, whereas
right.
3% is on 100K. So that is a difference on that. So
right.
it would
Absolutely.
be somewhat, we need to just see on that part. Okay. Gotcha.
But if you also see the refinance and getting the money is good, because this money you'll again reinvest on something and you will still multiplying it. So
yeah,
initially you got in, but you got some money back. That money will also make money for you. So,
right.
So this
Kumar, I think Mukesh's point is that if we are catching up for the first and second year on 100K basis point, and then in the third year, when we are catching up with 13.31 on 70, as long as we are catching up on, the preferred return, the accrued preferred return on 100K basis for the first 2 years first, and then we go down to 70K because that's what, because 30K will be returned back. That makes sense.
Yes, absolutely. The initial accrual will be based on your capital account for the first 2 years, which is 100,000, right? So whatever is owed based on your capital account is what will be accrued.
Got it.
In terms of numbers. When you come to the third year onwards, if there is any shortfall, which usually doesn't, from third year onwards, usually there'll be enough, because when we refinance, it means that we already stabilize the product and everything. Again, just wait for that slide, which will give you the details of what we're talking about.
But Mukesh, I think that answers your question, right?
Yeah, thank you.
Got it. Thank you.
So it's 8.86 million is the loan. We are getting 80 LTC. So they give also pay for the capex as well, and a 20% of down payment of the purchase price plus 1.1 million together is what is the loan amount. We are getting that at 4.6%. It's a 2 years loan, but they give, it's called a bridge product. Since it is a 66% occupancy, this is not it's called a bridge loan, because it's just a bridge before we actually go with the stable loan financing, which is the cheapest form. So this is a bridge loan, which is for 2 years term. They can give 1 year extension if need be. And our plan is to do refinance at the year 2, and then go into stable debt if we don't want to sell it in year 2. If there is always a chance that we could sell it at year 2, because if it's stabilized and everything, the market is good, we will most likely exit rather than hold on to it. because it's a win-win for everybody, and I'll tell you why it's a win-win to sell it early on. So the
Kumar, I have a quick question. Hold on.
Sure.
So this loan amount of 88600K or $8,860,000. The total cost for the procurement of the multiplex is at 9.75, right?
Right.
And then approximately about 1 million is what is paid outside of the loan.
No, it's part of the loan.
That's a
CapEx is
capex.
part of the loan. See,
That's
that's
a
why
capex.
it's clearly here, right? The purchase
it,
price
got
is
it.
9.75. Capex is 1.1. The down payment, which is 20% of the purchase price, is 2.17, right? So there is a closing cost of 707. There is an acquisition fee of 1% that goes to general partners. So the loan amount is 8.86, which covers 70. I have to update. Sorry, it was on the. I should say 80% of the purchase price plus the capex. So that's how the 8.860 is coming.
Okay,
And then the equity raise is the down payment that we need to pay plus the closing costs and everything is what comes to the 2.9 is the total equity raise that we have to do for this project. So the total acquisition cost is debt plus equity comes to 11.6. So the total cost of this project is 11.6 million. So the acquisition price is 9.75.
And Rajiv, we are
3 million
we are doing
close to what the raise is right now.
Yeah, we are doing the raise for about 3 million. Is that what it is?
Right.
Okay. Are you looking outside of this too, or this is the group so far?
No, we are looking at outside as well. Yeah.
Okay. Got it.
Yes, Sandeep, this one, since I know Kumar, I said, please make a presentation exclusive for our group, but he's making similar presentations to his own investor groups and others out there. And this is going to be like a public, correct me if I'm wrong, this is going to be available to everybody, correct? It's not exclusive.
It's not exclusive. It is a 506c offering. So that's why it's on, it's pretty much, it's, you can take any investor from the road. It doesn't need to have a pre-existing relationship.
Got it.
Anybody can invest. Even people who don't know you also can invest. That's what 506c offerings are.
I see.
Makes sense.
Right, but I think what I heard from you, Kumar, is that at the beginning of the call, the 506c is exclusive for 1 million generation.
Yes, it's only for accredited investors.
Right.
I mean,
right.
it's
So
open for
that was my
everybody
question.
for accredited investors. Yeah, you're right. I have to.
So Kumar, when you say accredited investors, which with worth 1 million and above, right?
1 million net worth, global net worth minus the personal residence, or husband and wife together making 300,000 for the past 2 years and expect to make the same in this year.
Got it.
I think if it's single, I think 200, I believe 200 or 250.
Got it.
Yeah.
Okay, Ashok, does that answer your question? So it's either, so it is for everybody or anybody who is an accredited investor. And the requirement is if your net worth is 1 million globally and above, or for a single earning member, it's like 200,
net worth
250.
minus personal residence. That's
correct.
The
That's what I'm saying. Net worth, right? I mean,
net worth minus the personal. You can't count the personal residence.
Yeah, your family residence you cannot put it in your net worth, so you need to take that out.
Okay.
Right.
Or as long as you're making 300 gross per year basis.
Right. Gross.
Or for husband and wife together, like partners together, or if you're individual
joint filing.
earner.
When you say partners, it's joint filing. If you're a joint filing and you're making $300,000 and above, you qualify.
Okay. And if you're single, then 200,
I think it's 200, 250. I don't clearly remember.
Okay.
Yeah.
Okay.
And just for the benefit of everybody, if you are working with your tax consultant, they will be able to give you that accreditation.
Right.
So just reach out to them. They have all your paperwork, all your documents already. So it might be a much simpler process rather than going through another third party, which will ask you for too much documentation. We went through that with Rajiv before.
Good, Sandeep, you brought it up, because for 506c offering, we have to get accreditation verification. before we accept any funds. So it's a
Yeah.
mandatory thing for 506C.
Yep.
Yep. Thanks for bringing up Sandeep. Yeah, Sandeep and I went through that through our CPA. So that's easiest for
Right.
that. Or you just give your tax document, which clearly shows in the last 2 years,
So,
300
Rajiv
and
and
above,
Kumar,
that's an
question.
alternative.
Yes, Srikanth.
Yeah, I know this accreditation is taking, you're saying that, but at the same time, you're also saying that this is for anyone who can invest 25K or 100K, right? That's what also you said. I'm kind of
25K or above.
No, if they are accredited, you can invest in Class A or Class B.
only if you're accredited, you can invest in this Class A or
Yeah,
Class B.
only if you're accredited. So that's
Okay.
why I started off saying that this offering is only for accredited investors.
Got it. Thank you. Thank you so much.
Okay, that was a good amount of education, and
Right.
thanks for clarification on that.
No
I
problem.
do have a very generic question on this.
Mhm.
Would you be the right person to ask? I don't know. I have some money that I want to utilize or park into something at this point after I sell my property. So there's going to be 1031 exchange that I'm looking forward to. How will this, if this will qualify for that?
Good question. There is another way apart from the 1031, which is what I'll probably explain you when that slide comes. That might answer your question.
Okay.
1031, yes, it's one way, but there is another way as
Mhm.
well, which I'll shortly show you.
Got it.
That's probably much easier way, honestly speaking.
Got it. And 1031 would work as well. Is that right?
1031, we can't do 1031 for this because that requires a complex structuring of the thing. It only warrants that if something like if you're bringing $3 million, then probably we'll be open to do a 1031 exchange. So if not
Yeah.
for a $100,000, $200,000, it's not worth us to change the entire org structure and everything because it requires tenants in common. So it will be like there's one entity that we are already creating, plus your entity together has to own this property.
Correct.
Then it will work. So it's
True.
called TX. It can be done, but again, as I said, like if it is a substantial amount of money, then probably we can talk about it. But if not, that's probably not possible.
Okay, so I'll wait until we get there.
Yeah, but I'll definitely show you another way of how to achieve that. So this is the underwriting spreadsheet I was talking about. So here gives the number. It's a simple spreadsheet income based on the rents we are projecting. What is the income, and and what is the expenses? We are projecting $55,000 as expenses. Since the year one, we are not projecting as a full income. So we kept a cushion of $50,000 just to cover the payoffs. So it's an interest only loan. So after we pay the debt service, we forecast to have 129K in the year one with us, of which 2% goes to the asset management fee to the general partners. So after that comes Class A share. Here in this example, I took like 230K worth of Class A shares. That's the underwriting we have taken, which means that 12% we have to give, which means 27,000 we have to give it to them. And Class B members, we owe 219,000, but we don't have 219,000. We only have 80,000 to give. So that's why it's only 2.93%. Okay, which means the deficiency 139K is accrued for the year two. It comes to year two, we have 224K left to distribute, of which take the asset management, then the 12%. The Class A is standard, it's 27, says they're getting standard fixed. So there's no change in that. So now Class B members return due became 358 because it includes 139 from the previous year. Got it? So now 358 is due, but we still don't have that much money. We only have 171K, which comes to 6.25%. Then, which means the 187 is still due. That goes into the bucket of next year. And are we in this year, are we able to give? No, this year also we have deficiency of 84. So that is eventually caught up in the year 4 in terms of the pref. I was just highlighting the pref part of it. So that is how the underwriting, and comes to the left. This is the exit. In the end of year 2, our net operating income, we are projecting to be 631K. At 631K at a cap rate of 4.8, we are saying that the value will be 13.165 million. It's a standard formula. In order to achieve what your value will be, you have to divide the net operating income divided by the cap rate, market cap rate. And that's how we generate this number of 13.165, which we are projecting to refi on a stable loan at 3.5%, which will be able to pay off our original loan and still give 816K into our pocket, which is what we are using to pay off that money to Class B's capital. Class A will still retain their same capital. We are not returning any capital because Class K members are cash flow guys. So we have to give them the cash flow. We don't want to reduce the return. So Class A will get, if they invest 25,000, that remains 25,000 until the exit. So after return, the Class B's capital account reduces to from 2.7 million, it becomes 1.9 million.
Gudu, can you pick up Sabir? Okay, I'm in the meeting.
So even after, we are not getting anything. Finance.
Doherty wali side, aage jaake, same place. So you make a right on the Bollinger.
Sandeep, can you go on mute, please?
नहीं दोहर्टी पे तो लेफ्ट ले लिया ना, आगे जाओगे तो राइट लोगे ना.
Sandeep, can you mute yourself?
Hey, Sandeep, can you go on mute, please?
Oh, I'm sorry. My bad.
No worries.
No problem. Okay.
Thanks.
So at the exit, we're saying at the end of year 5, the net operating income is going to be 705. So at 4.85 cap rate, the sale price we are projecting to be $14.5 million, which makes it a 150K a door in 5 years. But trust me, guys, the transactions are happening in the range of 135 to 140 right now in DFW area for C-class properties. But we are still underwriting in 5 years from now as 150K. So if that 150K, 140K, if we are able to sell it in end of year 2, we will definitely do that, because that shoots up our IRR. Instead of being 16 IRR, it could make us 25 IRR too, or even 30 IRR. Depends on what price we will be able to exit at the end of year 2, if things all go right. But that's a possibility, but we are underwriting based on a conservative scenario. We're giving ourselves 5 years term just to make sure that we will be able to at least deliver the returns that we are projecting here. So that's
Kumar,
right.
Kumar, just for some investors who are new to this, do you mind just explaining a difference between an IRR and regular return that we generally get, which is
I wouldn't want to really go into the textbook definition or anything like that. IRR basically goes on the time value of money, like how much money you're getting, and that can compound and everything. It's based on that. I don't want to, honestly, don't want to kind of go into detail, because that could open up a big financial discussion. So
okay,
in another way, like you're talking about how much you're multiplying the money, right? So in a layman terms, we are able to generate 85%. Like if you invested $100,000, you're getting $85,000 of upside in 5 years.
Okay.
That's why equity multiple, they say.
Okay.
But if you also see that if this 47,000, which is if we sell it at 150K a door, if this 47 comes at the end of year 2, what do you think is going to change? Your return is going to be 47 plus 6 plus 3. So let's say we're talking about almost like 55.
56.
55. Let's say 56. 56 divided by 2, that's your IRR. And I mean return. So you're talking about 25-26% return if we are able to get this in end of year 2,
Got it.
which is not impossible sometimes. Maybe let's be not 150. Let's say even like 140. Let's say we execute. And let's say this comes to like 40, just only 47. Let's think that this is not coming. Let's say only 47. That's the kind of return in 2 years, 47%
Right.
upside in 2 years.
Got it.
DFW, with the current market conditions, it's not impossible because it's happening already. But
Got
again,
it.
nobody knows the future. So no, and this is an offering. This is an equity offering. So there's no guarantees of anything to happen. So, but I mean, this is projection. Like, so this is a very conservative projection, but we definitely hope to beat this.
Right. So just for everybody, IRR is based on the time factor. So 16.6 is assuming that it's going to be a 5-year term. So as Kumar said, that if we exit in 2 years, that return on investment, actually the IRR becomes like 25. And then it kind of diminishes over the next, so more years you're in, the IRR reduces. It's kind of on a time factor.
Right. So that now this comes to this question. Okay. So I'll try to explain this on a very basic layman terms so that it's easy to understandable for everybody. Any real estate property, there is the improvements portion, which is the building portion, and there's a land portion. The land can never be depreciated. Only the building can be depreciated. Based on the US tax code, a commercial property can be depreciated in 39 years. So let's say if we hypothetically have a property which is valued like 1.25 million, land value is 250K, and the building value is $1 million. So based on the IRS tax code, the $1 million can be depreciated in 39 years. So whatever 1 million divided by 39, whatever the amount is, what is the depreciation amount if you're going with a straight line depreciation method. But in large commercial properties like this, we have a strategy called cost segregation. What is cost segregation is, instead of depreciating your building in 39 years using the straight line depreciation, cost segregation study, which is done by engineers who will break down the entire building into components, like how many dishwashers, how many fridges, how much electrical work, how much of copper wiring, how much is the sheetrock work, how much is the wood. If they break down into everything, they will be able to categorize items into 5 years depreciable items, 10 years depreciable items, and 15 years depreciable items. So once you break down your entire building into chunks of different components that constitute the building, you are able to depreciate that asset much faster. By doing that, instead of just getting like building value divided by 39 as your depreciation in year 1, there could be a very astronomical amount of depreciation. And again, in 2008, Trump gave us some nice brownie points on taxes. There is a bonus depreciation. Combined with both cost segregation and bonus depreciation, we are getting a huge advantage in the year 1 in terms of accelerated depreciation. And to put in a high level perspective, if somebody invests $100,000, they will be able to get a depreciation worth of $69,000 in the year 1. So which means if somebody invests, and 69,000, it could be much better. This is the hypothetical study, but when we actually think, it could be even 75% or it would be more, but just we are giving a high level estimate. So if you invest $100,000, let's say you're a class B investor, you invested $100,000. Year 1, what we said, 2.98% something, right? Let's say 3%. So you got $3,000 as distributions. So that's a income that you made, because it's a K1. You should have got a K1 for that income. You should have paid taxes technically. But now comes a negative depreciation amount in your K1 for your share of 100,000 as $69,000, which means your positive $3,000, negative $69,000. So what is it? Net negative 66K will be your K1 that's coming to you to be applied on your personal returns. So that's the reason I said, so did you pay taxes on $3,000 in the year one? No, because it's tax deferred. Same thing with the year two. Let's say in the year two, you made 5%, let's assume, and it's $5,000. Year two also you will have some depreciation, but let's assume there is no depreciation. So this negative 66 is carry forward to next year, because unless until you are a real estate professional, you can't consume that 66 negative for your W2 positive. It's only possible if you are a real estate professional. So assuming that you're not real estate professional, that $66,000 it will remain on your bucket, which goes to next year. So the next year there again positive 5,000, but there is a negative 66 already in your account. So now you're getting negative 61 for year two K1. So you're again not paying taxes on the year two. So it carries on for the entire hold period. Whatever the distributions you're getting, you will not have to pay any taxes on your personal fund, because it came.
Kumar, what does this depreciation offset? Let's say you're saying if you're not a professional, if let's say you have
offsets
about 66
real estate gains, offset real estate losses. So coming to Sudeep's question earlier, he mentioned, right? Let's say he got a gain. Let's say he sold some property, he made like $100,000 gain. If he invests, let's say $100,000 in this deal, and let's say we gave like $70,000 to keep it simplified. So he gets negative $70,000, assuming, through this investment. He will be able to use that $100,000 from his condo sale or whatever it is and offset it with this negative 70K. So his net effect is only he has to pay tax on 30,000. But if he plans well, he invests, let's say $150,000, then he'll probably get $100,000, enough to offset his $100,000 gain that he is about to kind of try to write it off.
Got it.
This year.
And if you don't use it this year, it will be sitting on your books.
Forward. Yes.
Okay, as it is, right?
Okay. Right. So Sundeep, does that answer your question? I told you that there is another way, right?
Got it. So this is through depreciation, or showing
this is the real estate loss. So you can use it for any real estate gains, which is what.
But it will come back to you when you sell it.
Sell it. Yes, that's what my question is.
Right.
But you can only defer it, Sandeep. It's only you're deferring it.
I never said it's you're not paying tax. I said deferred. I'm saying since the beginning, I'm saying it's tax deferred. So you will be okay. So now we can forget about Sandeep's question. Now we're talking in general. Why do we need the depreciation? Okay. So you could be asking, the benefit you are getting is on your current tax rate. So you could be a high income earner. Your tax rate is probably 35%. That $3,000, you're avoiding paying taxes at the 35% tax bracket, or whatever your tax bracket is. But at the end, this depreciation catches up, but you're only paying the capital gains tax. Again, if nothing happens to the tax structure, it is low than your current tax rate.
Yeah, it's a long-term capital gain.
Exactly. It's a long-term capital. So you're getting benefit at higher tax bracket, but you will have to pay at lower tax bracket. However, you also have a chance to defer it at that time. Let's say in the year 5, now this depreciation is catching up, right? So you're saying that, okay, I still have to pay like 15% capital gain, long-term capital gains, right? Let's say in year 5, let's say you put $100,000, it became cumulatively, let's say $200,000. Now you have to pay capital because of the depreciation caught up. Now you have to pay taxes on the $100,000 gain. Let's assume that. If you invest the money in the year 5 or some other investment that is again giving you negative K1, you can offset this gain with that negative K1 and just you move on. So if you plan it well, legally, you can defer it for X amount of period of time. So it's up to you.
Okay, so Kumar, I think this is a little bit of tricky because you can defer it. That's what I was hoping
Again, talk to your
for.
CP. I'm not a tax
Yeah.
expert. So I'm telling you that there is a provision, there is a tax benefit for investing in this kind of properties. You can definitely run it by your CPA and try to say that you're planning to invest in something and you're going to get a negative K1. How is it going to work it out? You can definitely discuss with your CPA and get more clarification.
Okay.
But there's a way out. My investors have used it. They all benefited it. So that's why I'm able to say that. Because my Atlanta property, we sold it this year. So my investors are using that to offset it.
So just to be clear, Kumar, so if let's say if I have 1 million that I am trying to park somewhere, trying to avoid paying taxes upfront. So I park it over here. If I park it here in this Manchester house property, first I will have to pay the capital gain or for the year 2021 for the sale of the house and pay the.
No, you are not paying capital gains. It will both come hand in hand. You have a gain event, you have a loss event in the same year.
No. This is after I invest in this. But what I'm saying is, because I had 100 or million in profit from the sale of my property, what is that's going to be taxed in the year 2022? It's a 2021 income, right? So I will have to
again. I don't know your specific situation, so I can't answer that. But assuming that you're talking about long-term capital gain from your whatever investment that you made, you would have paid long-term capital gains on that amount.
Yeah, so I'll have to pay that. That's what it's.
No, so Kumar, so what Sandeep, what he's saying is whatever money you made, you do owe long-term capital tax on it. But if you invest here, there will be a depreciation, a negative K1 that will come from this investment, which will reduce your capital gain tax amount, because now you're not taxable for the entire amount. There's an offset against it that can come from this investment in the first year.
Just a planning perspective.
Yeah.
You have to see how much is your gain. You have to invest enough so that it probably can eat up the entire gain. It's just a simple calculation. Your CPA will be able to tell you how much is the capital gain. Let's say, simply put, let's say 100,000, 70,000 is the capital gain that you will get from your investment. Then you have to invest enough so that you can get that that much of negative K1. So it's just a matter of planning. As I'm giving you a guidance, right? Like in this investment, we are giving a guidance of 69% of your invested capital to be getting. So you factor how much of that money, 69% you need to kind of, it doesn't have to be only this property. It could be other property as well. You could invest some amount in this one, some other capital. So it could be negative from one investment, this investment, all cumulatively can add up to eat off your positive gain from the other investment. It's just a matter of planning. Yeah.
Got it. Okay, thanks for clarification.
Any other questions related to this section? And again, you are supposed to discuss with your CPA on any additional personal situation, because I'm not a tax expert. So any personal situation has to be dealt with your own tax professional. I'm just giving you a concept on how these things work. Okay, so that's high level on the tax thing. And with that, pretty much we come to an end of this discussion. So we can open up for Q&A and discuss if anybody has. I don't know if people posted on the chat. Let's look at, Rajiv, do you want to take the questions on the chat and then ask me maybe?
I had
okay,
one
Russell gave the
question
definition of accredited investors.
All right,
which is good. Yeah, people, yeah. Oh, it's not a question. It's just more a clarification.
Yeah.
Right.
Thank you. So it's 200,000. Yeah, it is good. The single is 200,000.
So let me jump to the question, Kumar. So with what is happening in the United States, how difficult, like how confident you are you can find actually a general contractor to fix your property?
I'm very confident because all the partners that are involved, they all have the background of rehabbing the properties. These guys, both guys have had experience with rehabbing the
Well, are they available for you? Like, are they kind of what I mean? They sitting like what, waiting for you to get this property, or they working somewhere? I like. Can you be in a position you buying a property and they're going to tell you, we're gonna start 6 months from now?
We don't anticipate that. We already have lined up contractors for this process. We tentatively already have a schedule to start off right after the Thanksgiving. We
Okay.
are not Thanksgiving. Technically, now we pushed it because of the lender situation. Now the closing is in December first week is when we are closing. So we have to kind of, earlier plan was to close it in November. And then at that point of time, we had a schedule carved out with the contractor to start right after Thanksgiving, which probably we now have to move that into
So
December.
Kumar, if you don't mind asking, what is the commitment of your partners, the two people that you were?
Wonderful question.
Yeah.
Any senior lender, which is the lender who is giving $8.8 million. First part is, I told you that the limited partners don't have any liability on the loan. So somebody is guaranteeing this loan, right? So that's general partner. In this case, I am the sole guarantor of this loan. For a loan to be given by any lender, the way it works is the individual has to own, who's guaranteeing the loan, his net worth has to be more than the loan amount. So in this case, we're close to $9 million is the loan amount. So the person who's guaranteeing, his net worth has to be more than $9 million, first thing. So,
Okay.
so that senior lender is doing a lot more vetting about my record and my reputation before even giving any dime, right? That's all vetted. We have a term sheet. We're moving through. It's not, we haven't got commitment yet, but I meant to say that we have a term sheet. So, so the liability of the loan is, I mean, the guarantor of the loan is just the general partner. I'm the highest general partner stake, close to 40% on this deal. So, and I'm only signer on this loan, just FYI. The second thing, so that's my commitment to this project. The second thing is the senior lender also requires a 10% of the equity to be coming from general partners. So in this case, the $3 million, right, to the total equity raise. So the lender requires, nobody else might require, the lender requires and mandates the general partner to bring in $300,000. So we have to, it's not a choice. We have to bring $300,000. So
Okay.
that's the commitment, just to give you an idea.
So Kumar, the other two partners that you showed on the picture, so what's their, are they going to be bringing in the construction value, or are they going to be doing the property management?
The
What's
VFR
their
capital,
value?
nobody does property management. It is done by a professional company, Capstone, which I told is the property management company. The VFR capital does some part of the asset management, and I am also part of the asset management. Asset management means we are the ones who make sure the business plan is executed. So the VFR capital guys, especially the guy, these two people, Jana and Robert, they're local to Denton. They're just 5 minutes away from this property. So these will be the boots on the ground. So myself and VFR Capital have the responsibility of the asset management. So they're bringing a little bit of the asset management, and they're the ones who bought the deal. So that's their value add. And the capital raising is predominantly done by me. And we have another Yeti Equity Partners. He's bringing the rest of the capital. Predominantly, I'm doing the capital, and they're doing rest of the particle. And this gentleman, he wants to be part of the deal, just a little bit of experience. So he's partnering with this guy, and he's part of the deal.
I
if they
see.
raise the
So,
capital.
so predominantly from capital stack or from GP fund
I am the
standpoint is
highest.
generally you are the
I
highest,
am the
and the
highest.
other two
40.
guys you pointed out.
Right.
But the asset management company, they're mostly your relationship, which you rely on because they're boots on the ground.
Right.
And for that, they get paid as an asset management fee.
Right. Right.
Got it.
And then that 10% that's required by the GP,
Mhm.
that 10% is only on the raise. Is that right? It's not on the purchase price.
No, not on the purchase. It's on the equity required, which is 3 million in this case. So that's why 10% becomes 300,000.
Okay, so it's much smaller than I thought. Okay.
And Kumar, how long is your relationship with the two other partners from the asset management and the asset management company?
This is a third deal we have done, and we've been working since this beginning of the year. We have done multiple transactions with them.
So you do have a working relationship with them
Right.
already.
Right. This is the third deal between us.
And then a question there on the fees. So the acquisition fee, that like 97,000, I forgot what it was approximately.
Right.
That's a fee from the GPs or to the GPs?
To the GPs.
Okay. And so then you're okay. And again, I'm not questioning, I'm trying to figure out the number. So you're really not funding 10%, right? Because 3 million and you're getting 100K back to make the numbers easy. You're really funding 200K. Is that right?
Right.
Okay. So you're really funding whatever 200,000 goes into 300.
Right.
It goes into 3 million.
Right.
Okay, so it's even less. Okay, and the bank's okay with that, I assume.
No, the acquisition fee has nothing to do with the bank, right?
Okay.
It's for all the zillion hours that you spend doing these
Got it.
webinars,
No, I'm just trying to
talking to
question.
investors and everything.
I'm just trying to
Yeah,
question.
It's an income. It's an income.
So basically, it's like 6%.
It's a paycheck for general
Got it,
partners
okay.
because they don't see a dime until you sell this property. You know that, right? I've showed you that they don't see a dime
Yeah.
until you exit.
Well, there's a I think you put in there 2% management fee per year, so you are getting something.
That's also it's $2,000 a year, a month.
Okay. No. I'm just trying to figure out the fees. I'm not. Please. Maybe you're missing.
No. I'm just
the wording.
I'm explaining that it's not significant enough that you
Correct.
get
No,
rich off that. That's what I'm
Okay,
saying.
no. Okay, so let me clarify. I'm not questioning anything. I'm just asking where the money's going and where it's
because
coming
that
from.
2% goes to the asset management folks only. It's not goes to the entire GP pool.
Got it. Okay, so 2% per year acquisition fee goes to the GP.
Right.
Your raise is based on the equity raise. So that's how I was trying to figure out. Okay.
So Russ,
this
the
is
asset management fee.
21,000
Yeah,
is the asset management fee.
Yep.
Yeah, Russ, generally asset management fee could be a third party company as well. It doesn't
Correct.
have to be GPs.
Okay, so again, I'm just trying to figure out when I see a monster spreadsheet, I'm just trying to figure out the money. That's all. I'm just trying to figure out how it's being added and subtracted to get to the total. That's all.
Kumar, one more question I have. I know that the properties, this economy is kind of up and down every year. There's a different playback. What is the downside to this? If the economy is down or other things are going in unexpected, we don't have a plan for those. What is the downside of this?
Sure. Very good question. So what is the best event to define what is the worst case situation? Probably 2008 real estate crash, right? And what happened to the apartments? People just flew from apartments and lived under the stone? No, right? So that's the reason we invest in apartments, because we are not building luxury malls or anything like that. We are in the business of basics. Providing shelter is one of the basic necessity. So what these apartments are providing is the basic necessity, right? And especially B class and C class, there is nothing to go down. Like people have to live there. So this is the lowest on the food chain in terms of a shelter for people, right? So that's how we kind of feel very comfortable in this investments, unlike building a brand new construction which is subject to a lot of those ups and downs. What if we build something and then market goes down? Yes, I would be worried if I'm doing a brand new construction. But this is an existing apartment in an existing neighborhood for past several decades. So people have been living in it. Even if the worst comes, people will still have to live in it. So the things has to go on. And 2008 is a perfect example. The apartments were actually full because renting is the basic necessity. So the only downside to our strategy is, well, probably we might not be able to exit at the top dollar, but let's see if doesn't have to, you don't have to exit because it's a cash flowing property. Maybe you might have to give some incentives here and there, but even in the COVID time where people have not able to pay because of eviction moratoriums and everything, but ultimately you guys know what happened. Like government started distributing money. Rajiv can vouch for it. And ultimately the rent is covered by the people or from the government if government is putting some restrictions, because ultimately people have to live somewhere, and this is the basic. So we might have to not, we might not be able to sell it if the worst sky falls, and we might have to hold on to it and wait for it to eventually catch up and then exit. But it is
So
still cash
Kumar,
flowing.
just for a hypothetical contrast, if you could go back to the slide where you have that class A and class B sort of investment call out. I
Which
think
one?
it was
This
in the
one?
earlier slides.
Which one?
What is the payoff?
Mhm.
Keep going back. No, it's quite back where you have the payoff for class A and class B. There were two slides
Mhm.
even
This
further.
one?
Yep, these ones. Yep.
Mhm.
So in this, so you have your class A, which you are saying it's fixed cash. So I'm presuming that this would be paid irrespective of how the economy is doing. Is that right?
No, this is an equity investment. It is not a debt. So if you don't have money, they will also be pref returned. So if you, let's say you don't make any money, then you can't give anything to class A because it's an equity investment. It's not, that's the reason you're getting depreciation. If
Got
not,
it.
you
Okay.
would get a 1099. If you were to get 12% no matter what, then you would have got 1099 and no depreciation benefit. But you are getting a depreciation benefit because it's an equity investment. We underwrite in such a way that
Makes sense.
a
Okay.
class A is
Thing
definitely
is
get
true
paid and there is nothing
in
to be
this
caught up.
the class. Mhm. So they're paid. So possibly that is probably more safer than class B in that sense, right?
Right. Class A, we and class A, that's the reason we underwrite it so that we don't have to catch up class A. Class A, we underwrite it to make sure that we can deliver them without any issues. But again, it's still an equity investment. It's not a debt investment, so it's not a guaranteed.
Got it. Okay, thank you. Yeah, so this was thanks for clarifying that. Rajiv, do you have any other question on this one? I think this is okay.
And one point I would like to add about this thing, in world, we can only mitigate risk, but we can't eliminate it. So we try to do our best to mitigate it. That's why we invest in cash flowing properties from day one, and things which are like basic essentials. So because that's the way we mitigate the risk, by playing in those kind of investments, especially when we are dealing with other people's money.
Kumar, out of those people that currently staying, like it's a 60% occupied, right? Or something.
Mhm.
How many people are paying?
It's based on our collections report. When we did the lease audit and everything, we are definitely, I don't have the exact number before me, but based on the lease audit, they were pretty good in terms of the collections. There was nothing negative that came out of the lease audits and everything.
I think what the question is, if there are any non-paying tenants
There will
living there.
always be non-paying tenants. See,
That is true.
I am in this business for so many years. I
We
own
all are.
50
We
plus
all
rental
are, and
properties
we
in
know
New
what
Jersey, right?
it
I own 50
is.
plus rental
Or
properties in
how
New Jersey.
hard it is.
Yeah.
So I probably know something or other thing about thing. Non-payment is just a business process. So that's the reason you always have a factoring of vacancy cost, collection cost, and everything. That's
Right.
Well, we're trying to understand at this current property, right? What is a rate of people who is not paying? We understand it's a part of the business, right?
I
Is
don't
it
have the number,
10%?
but it is not something earth-shattering from our investigation. I don't have the precise numbers,
Okay.
but we did the due diligence and we didn't had anything abnormal, to put that way.
Is this, Kumar, something that can be asked for? Can we know that? Is that something you can provide us?
Yeah, definitely.
I think that'll be good to know. The reason for this is concerning for me too, because my unit that I sold this year already, I took a loss on it because my non-paying tenant was not only not paying in 2020, but he was also abusing the property. So he actually took down a lot of stuff, which was, I had to pay for it before I sold it. And I had to take a big hit to sell it. But so those concerns specifically this time, because of moratorium and powers that were granted to the renters, tenants, this was not expected, and nobody knew what else you could do. And you can't even go to the court to ask for justice for what abuse they were doing to the property and to the land, the owners. Anyway, so
That's why
I think that'd be good to
Texas.
know.
That's why welcome to Texas, because it's a landlord-friendly state, not like New Jersey.
That is so
That's
true. And
why we are not
I'm in
investing in New
California,
Jersey.
by the way.
Yeah, but it's
Yeah,
the
it's the
same.
same thing.
New
It's the
York,
same
New
thing.
Jersey, California, it's all the
Yeah.
same. That's why everybody wants to invest in Texas, because you can get them evicted in matter of weeks, unlike like 3-4 months. Now they've changed the entire thing in New Jersey. Now it's going to be probably like several months. So anyway, so that's why we are investing in Texas, because of the landlord friendly policies, and there is no eviction moratorium right now in Texas, FYI. So you can evict anybody.
Got it. All right, moving on. Thank you for clarifying that.
Sure. Any other questions, guys?
So I know you had a few of these calls already, so I was just kind of curious of the almost 3 million, how much is still open or kind of available to invest at this point? Is it like 50% full, 90% open? Just kind of curious where you're at.
First of all, we are not going aggressive because the timeline is December first week. So people don't want to wire the funds today for something that is closing in sometime in the first week of December. So we're almost talking about close to 2 months. So that's the reason we haven't even updated the slides on the deck for people to do. However, we already have like around $1.2 million of commitments. But we are not aggressively pushing it through than what we need, because there's enough time. So we not trying to push as much hard as possible.
Got it.
And you know, in the
Going
past, like
back to
Russell, like
this
how these
accredited
things were.
investor.
I'm sorry, go
I'm
ahead.
sorry. Yeah, going back to accredited investor. So how would it work? You just need a letter from CPA, right? Like what is
Yes.
Yeah.
Your CPA has to
CPA
just
can
send
help,
it.
or your tax returns, one of the two.
or I can bring my statement with $1 million, right? In the bank. Technically.
We'll still say
Sure.
CPA letter.
Sure.
Let your CPA see that and certify instead of you seeing it.
Yeah, it's a simple process. I think the CPA will be able to guide you very.
Hey, Nikolai, can you lend me that $1 million too? I'll also become a accredited investor.
There is a, PDF acrobat
Are we
for
planning
that.
to circulate that, Rajiv?
Huh?
Are we planning to circulate that money for
Yeah,
everybody?
we just changed the name from Nikolai. Hey, from Nikolai Fortuna to Rajiv Katuria to Mukesh to Shrikant to Russell. We just keep changing.
This is how that happened, right? 2008 happened. This is how exactly it happened.
We'll give you a fee for that, Nikolai. How about that?
Yes. So going back to that accreditation, I assume this would be similar to the other properties like Longview and Lubbock, and I guess Stony
No, it is
Hill.
not, Russell. The Longview and all the other previous deals of mine were 506B, which means that if you it is a self-certification in those cases. Verification
Okay.
is not required, but in 506C, you have to get a verification, which is through a CP letter, or there's some websites that offer as a service to where you put down your information and they kind of give you that letter which you can furnish to us, which we can take as verification. It's unlike the Longview. So Longview and everything, they are 506B offerings.
Kumar, do you work with any of those accredited
Yes. Right. There
services?
is a website. I'll post that also on the slide so that it's easy for people.
So Russ, I have used that before, where most of the companies, can refer, hey, you can talk to these agencies. You upload the documents and they'll certify.
You have to share accounts over the web, or just...
You have to upload the documents. Most every pro capital account, but you work with them directly on it.
Well, I just don't know how they know about your liabilities. Like, you have to have your assets is a difference between your actually physical assets and your liability, right? So how does
it's like, so consider that as a PFS, that when you start filling it out, and then at the same time they'll ask you for support documents for it. But again, it's a process. You can show the same thing if you don't want to go to an agency. Show that to the CPA. He probably knows that already by now, since they filed your taxes and all that.
I do my taxes. I don't trust them.
So so you're screwed, Nikolai.
So
all right. So
a
Kumar,
CPA letter is okay. You're saying like a standard CPA letter is fine versus going through.
Right.
Yeah.
Okay.
Yeah, CPA is a straightforward process, because we went through this process, and I know the documents that you have to upload can be very exhaustive, because they will ask you for statements, for timestamped documents like liabilities and assets. So you'll have to do all that, all your bank accounts, everything. But with the CPA, I don't think you need to do any of that. He will probably have background with your previous taxes, returns, and all that stuff. Maybe with the basic stuff that he might ask you. That would be straightforward, most likely.
Right. Hey, I had just one question on depreciation benefit for the first year. Let's say we close in December, right? The depreciation of 69% of pretty much my investment, if I go with 100,000, will it be 1 month?
No,
because
it
I'm
will still
closing
be
it
the
for the
entire.
whole calendar year.
It will be the whole calendar
year, right?
You'll get this.
That's what I thought.
As long as we do by December 31st, you'll still get the K1 for that negative amount.
For this year. Got it. Okay.
Because if it was straight line, then you would have got only like 1 month. But this is accelerated, so majority of the money is coming you because of that event that you did.
Got it.
So are you flexible on the timeline and the amount of money invested, probably installments, maybe some of it this year, some of it next year, early next year, January?
Unfortunately not, because as you know, this offerings get, once it is closed, which means we have enough money to do the acquisition, it is done. So we don't usually raise additional capital later on.
Got it. Is that something that you have to follow through, or is this something that you will probably decide at a time when you have that choice?
It's a process because you're raising the capital to purchase the property, and for the capex, which is also in the initial months. So once you start that money, you don't need that money because it's a cash flowing asset. So it has to perform going forward later on its strength.
All right.
All right, guys, do we have any questions specific to this project?
So when do you need the commitment by?
We need the commitment and the funds by end of next month,
Right, but like
by end of November.
So,
Let's say around Thanksgiving time.
Nikolai, what I can do is I can make it easier. What I can do is I can create a WhatsApp group or something. You guys, anybody who is interested can let me know. And I can convey the soft commitment. I can create a WhatsApp group, include the guys who want to make a soft commitment and include Kumar in it. And you know, I could be the admin there. And then when the time comes, you know, he'll circulate information within that group and kind of keep guiding us that, hey, this is the time, this is how you wire and all that stuff.
That
So
sounds good,
anybody who is
Rajiv.
interested, I can take a lead on that and create a group and add people who want to give a soft commitment to begin with. And Kumar, you still going to be using your portal, your dashboard, your investor portal that you have for this
Yes,
investment as
absolutely.
well?
Yeah, it's the same
Okay.
thing, investor portal. The links that people can see, it is the links to access that portal, which hosts all the
Okay.
information.
Got it.
Okay. And just before we end up, apart from this Denton 97 units, we're also under contract on another property, which is also going hand in hand. And that one is closing sooner than the Denton, because Denton is
The one in
first week of-
Houston, Kumar?
Yes, this one is closing in first week of December, but that's closing on November 8th. So that is the one
November
that
8th.
I'm actually working on right now, November 8th. So if you guys are interested, we can again do one more. That's a 440 units in Houston, Texas. It's similar offering. It's also an existing apartment complex. It's a much bigger project. It's a $40 million acquisition. So if you guys are interested, we can also present that opportunity as well.
And that's a 506C too?
That's what my
Absolutely.
question is.
It's 506C offering, yes.
So it looks like you do only 506, I guess.
Going forward, I plan to only do 506C offerings because since the beginning of this year, since we did like 3 projects, when I saw the analytics and I was looking at my investor data and everything, 95% of my investors are accredited. So just to get the non-accredited, why do people do 506B is because it allows you to get 35 non-accredited investors. But when 95% of my pool is anyway accredited, so I'm losing out the benefit of blasting it on social media, because 506B, you can't advertise on social media. You can only send it to known people. So, you know, in these days, by not going social media, you're dividing yourself with the greatest tool to get exposed and get.
Kumar, you're breaking off. I think it would be better if you can just repeat that. You're breaking.
Yeah, I don't know why the internet is a little unstable here. I'm sorry. Is it better now?
Is that only me that I?
No, it's everyone.
Yeah.
Oh,
Hey, Kumar, you're breaking up.
I don't know what. Maybe some videos are going on or something. I
now.
don't know why the internet became unstable.
So Kumar, you can turn off your camera. That might help.
Yeah.
You're still cutting off.
Is it better now?
Kumar, if you don't mind, can you turn off your camera and try again? Oh, he's
I
off.
did.
Okay.
I did.
Yeah.
I think it's better now, I believe.
Okay,
Yeah.
perfect.
Right.
Yes, it is better.
So what I was saying is by going 506B, the only advantage is you can accept 35 non-accredited investors. But what are you giving up to get that benefit? You can't post it on social media. You can't solicit to any people that you don't know. That's a huge hindrance. 506C strips off your acceptance of non-accredited investors, the 35 non-accredited, but gives you the complete freedom to post it online, post it anywhere on the social media without any issues. So we kind of, when we came to know that 95% of our investor pool anyway is accredited, so we then decided now saying that we should use social media and then not worry about this relationship game and just float only 5 or 6 C offerings going forward.
Yeah, I think in our group, there's nobody accredited for Rajiv and myself. We actually did just recently. Before that, it's always been word of mouth and just local investments. So
Right.
it's a good place to be, I guess, to get that
No, I think
accreditation.
it's a process. I think we never had to do that before, so that's why we didn't do it. But I think it's good and it opens doors to a lot of other investments. So I'll highly encourage everybody to get accredited anyway.
So I think we almost like 2 hours into it, didn't realize that. So it was, we were going with the flow. That's
Hey, Rajiv, I have a
fine.
question. For LLC, how do we do that? Accredited investor for LLC, how do we do that?
usually like if all the members of the LLC are accredited, the LLC is also considered accredited. Or if the entity has to be accredited, it has a $5 million net worth requirement.
Mhm.
So that
Got it.
LLC that you will probably form or whatnot, like they have to be accredited or something, if at all you're forming. They all have to be accredited.
Okay.
Yeah,
Got it.
and Venkat, there is a very clear guideline on how to get accredited as an LLC, as an individual. So I think again, if you ask your CPA, he'll guide you.
Okay, got it. Yeah. Anyway, thanks, Kumar. This is a wonderful presentation. I have to drop off now, but
Sure,
we'll
I
be in
think
touch.
we are anyway 2 hours. I think it is, we kind of answered everything.
Yeah.
And again, any other
Yeah.
questions, again, you can ask Rajiv, and then Rajiv can also direct it to me. So feel free to ask any other questions. But I think it's we spent good amount of time, and hopefully I added some value for the 2 hours that you spared with me. So hoping you got some information, and we'll love to see you guys on board.
Absolutely. No, thank you so much, Kumar. It was
Thank
very
you, Rajiv.
informative. You gave a lot of insight, so which was very helpful. So I'll get in touch with you, and I'll, as I said before, anybody who is keen can reach out to me. I'll create a group, start adding them for the soft commitment. And I'll talk to you and let me know how the Houston things looks, and maybe we'll set up another call for that as well.
Sure. Sounds good.
Thanks.
Well, thank you so much.
Okay, guys, thank you very much, and good
Thanks,
night.
guys. Yeah,
Good
thank you, Kumar. Thank you, Rajiv, for putting this
Yeah,
together.
sure.
Yeah,
Anytime.
thank you.
Thanks, Kumar.
Thank you. Bye.